Hi, I'm John Stevenson, the Guaranteed Retirement Guy, and we are going to talk today about too good to be true scenarios with annuities. Are annuities too good to be true? Is your advisor showing you a scenario where it just looks really good, almost too good? Okay. Maybe he's showing you participation rates of 300% or really, really high caps. Does any of that ring a bell to you? Well, if it does, then let's talk, okay? Because annuities are very, very powerful, and they can be very powerful for growth. They can be very, very powerful for income. But if you're looking for something that is giving you 50% in returns, you might want to look elsewhere, okay? Because a lot of times advisors are selling you the dream, selling you the too good to be true scenario, and you want to believe it. And they make it believable, but in the end, it's not how it seems. All right, so I'm going to share my screen, and I'm going to show you everything that is available, okay? And then you be the judge. You tell me if it's too good to be true. Okay, so a lot of annuities are linked to indexes. And I'm showing you fixed index annuities, which right now are paying a lot. Why are they paying a lot? Why are you seeing a participation rate of 550%? Do you know what that means? That means if the company or the index, if it grows at 10%, they're going to credit your account at 55%. Whoa, that's crazy. Well, it is crazy. Let's go down here. This is 335%. Oh, but they charge you an account fee of $95 to get that. Okay, well, what about this? This is even better. 465%, but there is no fee. Wow. So you can see a lot of the fees. Some of these have fees, some of them don't. But look at the returns. 10 years, 21%. 15 years, 53%. Well, that's beating the stock market. How is that even possible? Well, is this a too good to be true scenario? Well, let's talk about this. How do annuity companies make a 50% return if the stock market's doing less? How do they do that? Well, they do it simply by buying call options associated with an index or a stock. Okay, and if those call options, when they bought them, were super cheap, they bought them in bulk, and the market or the index went up at a huge rate, then they're able to exercise those options and make a ton of money. And that's because they bought those options at a very cheap rate. Now, keep in mind these options expire, especially if they're not exercised, they expire. If they are exercised, then you obviously make money. But if they're not exercised, which often they are not, then you make zero. And then what happens? Well, the insurance company buys more options. But guess what? That time, maybe their $10 billion buys half of what it did the year before. If that's the case, they're going to lower your par rate. Instead of getting 550%, you might get 100%. Or what if they lower it to 50%? Did you know that some of these contracts actually have a minimum rate of 5% participation rate? It's buried deep in the contract. So you got to ask yourself, is this too good to be true? A lot of them, they are. And so let's look at one, and I'll just give you, there's so many examples, but I'm just going to show you one right now that I do like. It's Mass Mutual. And I've talked about Mass Mutual before. And it's the reason why I like them. They don't give you like a participation rate, but it's very clean cut. They'll cap you at 10%. It's the S&P. We all understand the S&P. Okay, and they will lock that for 7 years. What does that mean? That doesn't mean they're locking in 10% growth. That means they're locking the cap, which means they're not going to lower the cap next year or 2 or 3 years. So if options go through the roof, they're not going to charge you for it. Okay, which means if the index does well, they're going to give you all the way up to 10%. If it goes over 10%, 12, 13, 14%, they make the difference. That's how they make the money. But it's also being protected 100% from market risk. So that's typically what I look at. And I explain this to a lot of my clients, especially when we get these big participation rates. So there's nothing wrong with some of those annuities that will give you that. You just have to understand they are reset at the end of the period. If it's a 1-year period, they're reset at the end of 1 year, and it changes to whatever the new rate is. Okay, it could be low, it could be high. Same with caps. The nice thing about this particular one is it is locked in for 7 years. So if you want to keep it there, you know that particular index is not going to change. They're not going to lower the cap. Okay, they're not going to add a participation rate. That's what you see is what you get. So I do like that. But here's another one. They also give you a cap, and it's 14.5%, and that's 7 years locked in. Wow, that's with Barclays. So it's a little bit different. It's not with S&P 500, but you can kind of mix it among these if you want, and the growth is not bad. So when you're looking for stability and you're looking for something that you can trust, typically look for these type of annuities and look for a good company. Okay, good companies will usually not try to sugarcoat things for you. So let's talk about something else that might seem too good to be true. Let's talk about the income rider. And people ask, well, how can they give me this much income, right? How can I get this much income? And I'm going to change this to $450,000. Okay, so $450,000, I'm 60 years old, and I want to take income right now. Well, right now, that income would be $32,400 guaranteed. That's if I took it immediately. But what if I decided to wait till 62? Maybe I want to wait till I turn 62 and I'm going to take Social Security, plus I'm going to take income. Well, let's make sure that we get the highest income with no reduction. That's going to show the top annuities, which right now, Equitrust is the top one. So for $450,000, I'm going to get $43,000 a year guaranteed for the rest of my life. That might seem too good to be true because you're thinking, all right, well, wait a second. 63, I'm going to probably live 30 years till I'm 93. So wait a second here. That's a lot of money. That's like $1.3 million. How's the insurance company? How can they afford that? How are they giving me this? They're required to have all these reserves, 80 to 100%. What is up with that? How are they even able to have those type of reserve requirements? Well, keep in mind, insurance companies are more regulated than banks are. Okay, so they have to have the high reserves. But also keep in mind, they're investing in things like indexes through call options, and they're able to make a lot of profit from that. And they're able to do that because they're not sharing it all with you. Okay, that's how they're able to share it with you indirectly through income. Okay, and so if you're looking for income, well, look at this. Let's look at this scenario a little bit more. They'll show you two. One is if the index earns nothing, absolutely nothing, and they're not giving you very much of the S&P. I think this one they're only giving you like a 2.5% cap. So it's not big on growth, but it's big on income. And if you're looking for income, it's a lot. Okay, guaranteed. And you'll notice that account balance will go down eventually to zero, but the income will continue. Okay, that's what's so beautiful about this. And you'll notice with the one that actually has really good growth, even with decent growth, you're still taking out a ton of income. Your account balance will last longer, but it still is gone by the time you turn 80. Okay, so it just doesn't, it may last a little bit longer, but eventually it's gone, but the income, it continues. And so a lot of times people say, well, how is that even possible? Too good to be true. Well, guess what? The insurance company, they know exactly how long you're going to live, folks. They know. They sell life insurance too. And they know how long everyone's going to live. And so they can give you and guarantee you income. They can guarantee people life insurance proceeds because they know exactly how long people are going to live. They know how much income they're going to have to pay out. You may live till 100, but someone else might live till 70. Okay? And they know that. And so because of that, they're able to sell you these and be able to give you this guarantee, which to me is beneficial for them and beneficial for you. For them, because they're able to stay safe and stay in business for hundreds of years. And for you, you get guaranteed income. Never, ever runs out. Like, ever. Okay? So if you want some guarantee, okay, if you want to think about maybe just taking a portion of your portfolio to put it into a contract that is not too good to be true, but really is what it states that it is. And if you want to talk to an advisor that's not going to blow smoke, not going to try to sell you into something and promise you these ridiculous returns, then book a call. There's a link below this video. It goes straight to my calendar, and we'll talk. I'll ask you a few questions. You can ask me questions. I'm not going to try to sell you anything. I'm going to show you everything that's available, regardless of what the commission pays me. I'm happy to do all of that. And so I hope that is I hope that's valuable. Hope you find that valuable. And I hope that you feel comfortable reaching out. If you don't want to book a call, you can certainly reach out through my website, johnstevenson.com. And you can also explore annuities there. Okay. I give you access to a smaller version of this software that you're looking at right now. So at least you can see what annuities are paying. And then at that point, if you want to talk, reach out. Okay. I don't bite. I'm not going to try to sell you anything. I just want to be helpful and show you that there are some great options out there right now, and you should be aware of them. So again, if that makes sense, book a call. There's a link below. Again, thanks for watching, and we'll see you next time.